Michael, welcome to the Bitcoin Standard podcast.
Happy to be here. Thanks for having me.
The pleasure is all mine. It's always great to have you here. And this time it's a bit of a special occasion. You've just completed your first Bitcoin cycle. You've done 4 years in Bitcoin. So you've gone through an entire halving cycle, 210,000 blocks, kind of like the um, initiation rite of being a Bitcoiner. You didn't sell and you didn't rage quit, which is an incredible achievement because the mass majority of people don't make it that long. So congratulations.
Yeah, I feel like I graduated from Bitcoin University. Started August 10th, 2020. Just kind of finished my senior year. I'm not quite sure. Does this mean my first year in the workforce, or is this my first year in grad school?
Well, I mean, it depends on what you want to do, and I think it's
Working on my master's degree, maybe.
no. I think you're pretty much ready out for the real world. So, any regrets? That's worked out fine, I would say, right?
No, it's been fun.
So I was running some numbers before we went on, and I looked at the market cap for MicroStrategy, and it is today around $25 billion. And on August 10, before you got into Bitcoin, it was at $1.2 billion. So you've done yourself a nice 20x with change on the value of your company over the last 4 years, and you've outperformed every single company in the S&P 500, right? Or I guess some days Nvidia will overtake you on the 4 year basis. Sometimes they might, but you're in that league, right?
Yeah, actually, I have a little chart here I try to keep. So,
Yeah, you want to share it?
well, why don't I just tell you, right?
All right, yeah, go ahead.
I've got it in front of me. MicroStrategy is up 964% since August 10th, 2020. Nvidia is up 934%. So we're still outperforming all of the 500 S&P. Nvidia is the number one performer in the S&P. Bitcoin's up 387%. Microsoft, Tesla, Google, they're all up like 100% ish. And I keep track of all the various asset classes since we got into this, and that's also very interesting. The S&P is up 66%. So Bitcoin is like 6x. Bitcoin is 388 versus S&P 66. And gold's up 25%. And silver is up 3%, and bonds are down 16%.
Yeah.
Yeah, so the interesting thing, of course, is no one would have thought that MicroStrategy could outperform all 500 members of the S&P 500. I didn't even think that. In fact, we didn't even realize that. That snuck up on us. It didn't. Our benchmark wasn't that. Our benchmark was Bitcoin, right? So we were actually just trying to keep up with Bitcoin. So I think you could have guessed that Bitcoin would actually outperform the S&P. And our initial goal was, how do we get to the point where our company's market cap tracks Bitcoin's market cap? But along the way, we levered the company, and the only way to beat Bitcoin is more Bitcoin, right? And and that's why every time people offer you, they pitch you all these business ideas, right? And they're like, well, do you want to invest in this business or that business, or do you want to invest in this real estate? And I say, well, Bitcoin's up like 46% ARR every year for the past 4 years. So, and that varies, but anywhere from 45 to 55% is the ARR for Bitcoin. So I think, okay, so 50% is my risk-free return. So are you going to give me a proposition which is risk-free better than 50%? And like, and of course, no one's got a proposition that's risk-free better than 50%. So then the question is, well, how the heck are you going to beat better than Bitcoin? And the answer is, the only good idea is borrow a bunch of money for 5% and buy Bitcoin with it. Right? If you can borrow money for 0% or 1 or 5 or 10%, and you're buying Bitcoin and it's returning 40 or 50%, then that's a good idea. So I think Bitcoin's a good idea. I think different ways to securitize or lever Bitcoin Some are bad ideas, like, for example, trading 20x leverage on Binance on Saturday night. That's not a good idea. Trading on FTX, or, on the crypto exchanges with like mark to market massive leverage is not a good idea. But, if you can take a 30-year mortgage at 3% interest and buy Bitcoin with it, and that's a good idea. And maybe you remember, you lived through the many epics. The last epic is about a 45 to 50% ARR. The previous ones were higher. And I think it's the law of large numbers says that as Bitcoin approaches the market cap of the S&P index, or the market cap of all the equities in the world, it'll start to approach an ARR and a volatility which is lower. I don't think it'll ever get to the performance of S&P. I think it'll always be better than the S&P index. And I think, like, right now the ratio is like 46% for Bitcoin versus 12 or 13% for the S&P. So it's like 3.5x performance, and it's like 2.5 vol. So the Sharpe ratio is higher, right? There's a higher Sharpe ratio of the S&P. The performance is much higher. And I just believe over time, Bitcoin will converge toward the S&P times two, and 50% more volatility in the S&P and two times performance. Or if the S&P, gives you 12% a year, then Bitcoin ought to be 20% a year. And so that being the case, we did this Bitcoin 24 model, and the 24 model is a 21-year model. And my base case is 29% ARR for the next 21 years. And at 29% ARR, you end up hitting $13 million of Bitcoin in 21 years. So that being the case, coming back to every pitch I get, okay, well, you have a pitch. Can you guarantee me 29% ARR risk free? And another way to say it is, that's the risk free rate. So can you give me 39% with no additional capital required for the next 21 years? And if so, it's still not a good idea because it's a distraction, right? Right? It's still a distraction. I'm taking risk, but it's maybe an interesting idea. But of course, as soon as you set that as the cost of capital, 29% risk free. I mean, the risk-free fiat rate right now is 5%, right? Or actually, after tax, really, the risk-free rate has got to be the after-tax bond yield. So maybe it's 3%. So it's 3% if you think conventionally in fiat terms. But if you're thinking Bitcoin terms, it's 29% for me. You can have a different forecast. But it's very clarifying, right? Because as soon as you actually set that, you think, well, there's really nothing that interesting to me, other than what's interesting is companies that can raise capital to buy Bitcoin, and intelligent leverage ideas, like raise $1 billion for 0% interest and buy Bitcoin with it for 7 years. Like, those ideas are interesting to me, but there has to be Bitcoin on one side of the idea, and the other side of the idea needs to be an arbitrage of the extremely cheap fiat interest rates.
Yeah. So I think I saw that presentation. It was very interesting, and I wanted to discuss it with you. So I got the slides here uploaded. Let's
Okay.
share them. Oh yeah, there it is.
This is from Nashville. Yeah.
Yep, the one from
Okay.
Nashville. So this is
Yeah.
the forecast that you made.
Yeah.
So here
Right.
you're saying the bear case is Bitcoin's at it's making about 21% annual return rate. Base case is 29%, and bull case is 37%. But in context, this is I think it's worth mentioning here that this is compared to a world in which, yeah, so these other assets are also making rates of return. So Bitcoin is at 29%, but gold is at 5%, art is at 9, equity is at 10, and real estate is at 7, bonds are at 5, and money is at 7. So I found this really interesting, and I sat and I ran a bunch of numbers, and I thought about it a lot. I think it's a very interesting way of thinking of Bitcoin, because you're projecting different appreciation rates where Bitcoin continues. And now this gives you a sense of what the scenarios are going to be depending on what happens to the Bitcoin price and all these other things. But I think the way that I thought might be more useful to think of this is to compare Bitcoin only to bonds and money rather than these other things, because these things you would expect that in the long term, as you say, as Bitcoin becomes more useful as a medium of exchange and as a store of value, people are going to get rid of their of the gold, art, equity, and real estate that they hold as a method of saving, right?
First of all, this Bitcoin 24 model we put in the we open sourced it. It's in the public domain. So if you just Google Bitcoin 24, you'll find the GitHub. When you go to the GitHub, you can download that spreadsheet. That spreadsheet has a macro model, a Bitcoin model, and a bunch of micro models for corporations, individuals, institutions, and nation states. In the model, everything's annotated. All of the assumptions are there, and you can change the assumptions. And in this particular case, there are assumptions about the inflation rate, macro inflation rate over the 21 years. There are assumptions about the innovation rate. And then there are assumptions about the monetization or the demonetization of various asset classes. And if you
Yeah.
look at that slide, what you can see is we're assuming a progressive demonetization of gold,
Yep.
and a demonetization of bonds and to a certain degree money. But we're assuming that there's going to be innovation and equities will benefit from things like technology and AI. Like for example, if all the cars in the world drive themselves, or you can manufacture humanoid robots, then maybe you'll see companies that have no employees, but they sell millions of humanoid robots made by robots. So the equity will be valuable. So there's some asset classes that look like they'll grow that we think will grow faster than others. And art, like you can look at that variety of different ways. Maybe you think art will be demonetized faster, in which case you go tweak that. And in this particular case, this is showing it creeping at 9%, but you could view art as gold and decide it's only going to creep at 5. Or we just figured art would be better marketed and it's prettier than gold over time. We're thinking, but anybody can go and adjust these things and make their own assumptions about what'll happen, and then they can come up with their own macro view of the world. That's what's cool about the model, and I would definitely encourage you, Safe, to grab the model, look at the assumptions, tweak it, and come up with your own Bitcoin view and your own macro view. Because I think when you start to ask the question, how does equity sit with real estate, sit with bonds, sit with currencies and art and gold as a long-term store of value? That's very interesting. I mean, I think you've encouraged all of us to think that way. And I just see the world as there's a bunch of assets that have utility value, and then there's assets that are primarily store of value. And if you think about the portion of our long term capital, our store of value, clearly that ought to be moving toward Bitcoin much faster. And then everyone's going to want to have their place to live and things that they like, that they brag about, their trophy assets. My self image is I own the football team. Right. And so some people will pay a lot of money because the idea of being the owner of the New England Patriots is worth billions of dollars to them if they're a citizen of Boston or something. So there'll be things like that. But ultimately, clearly Bitcoin is global capital and it's the best asset. So we think it'll grow the fastest. And that model, my base case there is 0.1% of the wealth in the world growing to 7% of the wealth in the world. But go ahead from there, with the caveat that you're working with my base case and you can have your own. It's everybody can have their own assumptions. What are your thoughts?
Yeah, so I actually did exactly what you said, which is take these numbers and look at them and to try and run them myself. And I think it's tricky. I think the tricky part about thinking about these numbers is to think about how the change in the value of the money supply is reflects on the change in the growth rate for the money. So you put a 77% annual rate of return on money,
Yeah.
which suggests that the value of money increases at 7%. But in reality,
Well, value is a funny word.
exactly, that's the tricky part.
We're just cranking in the monetary inflation rate for the past 100 years, which is your number, right?
Yeah,
So in US dollar terms, right? So an average increase in the US dollar money supply of about 7% is the base case.
yeah. But
The value of the money isn't going up. The value of the money is flat, right? I mean, and right, we've already established that, right? That things
well, but that's the tricky part because it's not exactly staying flat. It could go up or it could go down. So the supply, so it's in a sense, it's a little bit like you're comparing apples and oranges when you're looking at Bitcoin up 29%, which means up 29% in terms of dollars. Okay, but then what is the
that's
dollar
true.
up in terms of? So I thought the way that I would formulate this in order to,
Oh, yeah, you can actually calculate real as opposed to nominal, and the problem with real is, again, the price of every single thing in the economy is changing at a different rate.
yeah,
But, so, yeah, this is obviously it's just a nominal number over time, and we're just cranking in a 7% increase in the currency slash what, fiat money supply as the base case. If it was, Turkish lira or Argentine peso or something, and you cranked in 14% or 21%, you're gonna have massively larger numbers. But of course, there's no point in that because the world reserve currency is the dollar. So, yeah, we're coming back to the US dollar base rate, but and we didn't build it to forecast currencies versus currencies, right? They're all just thrown into that bucket called money.
yeah. I thought one way to get around this is to think of the Bitcoin annual rate of return as being opposed to a bear case, a basic case where bonds and money is set at zero. So that way, we're just thinking about the growth in the market cap of Bitcoin in terms of bonds and money, because that's really, in my opinion, what Bitcoin's up against. Whereas the others, I think, would
Well,
look.
we disagree with that. Like, I don't agree with that at all, right?
Uh-huh.
In fact, I think that Bitcoin is not up against that. I think that Bitcoin is competing with all assets. It's clearly demonetizing gold. It's also an alternative to real estate. It's also an alternative to equity.
Gold is a rounding error next to money and bonds. You're talking about
Mm.
400.
Gold is not a rounding area compared to Bitcoin. It's 10x bigger than Bitcoin.
Yeah, but
Right.
I like to say gold is the appetizer, fiat and bonds are the main course, and real estate and art.
You have an opinion. I just disagree with your opinion. I just think you're characterizing this very narrowly. There are a lot of people that are gonna buy a Bitcoin instead of buying a second apartment as a rental investment property,
Yeah,
right? And you wanna dismiss that as relevant, but it isn't irrelevant, right?
no, it is relevant. I think.
The fact is everybody has to they have to decide how they're gonna allocate their wealth across all these assets, and there are some people that make a lot of money and they buy 1 house, a second, a third. I know people that buy 27 houses.
Yep.
Okay, I know them, like land. The term land banking has been around for 30 years, as long as I can remember. People just take money that they made in their random investment banker job and they buy real estate just to bank the money, right? So I
Yeah.
mean, it's this is not Bitcoin is not just a competition against currency, and you can argue, for example, in the United States, it's absolutely not a competition against currency. In the United States, people aren't buying Bitcoin in lieu of holding dollars. There's no one with capital to invest that hasn't invested in dollars. I mean, every investor in the world has their capital invested in the stock market, primarily in equity or real estate, right? Otherwise, some people might be invested short term for bonds, but wealthy people in Europe and the United States aren't choosing between moving from US dollars to Bitcoin, right? They're choosing to not buy a building or not buy land or to sell their Nvidia stock to buy Bitcoin. So those comparisons really are pretty important to people in the Western world.
Yeah, and if you see here, I think you can see my screen, right? So if you
Yeah.
see here on scenario two, this is the one that I was referring to, where I said bonds and money gave them an ARR of zero, so that they're the metric that we're measuring against. So how much is Bitcoin going to grow on top of the real uh, growth or shrinkage in the money and bond markets. And then we give gold, art, equity, and real estate negative ARRs, which is, in my opinion, not for the assets themselves. Equity market isn't going to go to zero. But I think people using equity or art or gold for the sake of saving is what's going to trend towards zero. In the sense that, yeah, all of these people you talk about who do land banking are going to over time realize that Bitcoin is better, and you'd expect Bitcoin to decrease. And then land markets are going to be for buying land. If you need the land, you buy the land. If you need a way to store wealth to give to your kids, you just buy Bitcoin. So if you run these numbers, I found that it is actually at exactly 29%, the same number you gave as the base case. If we give Bitcoin at 29% and give bonds and money zero, in your case, you gave bonds a slightly less 5%, I think, so it was less than Bitcoin, and you gave money a 7%. But if we give them zero and we give Bitcoin 29, and then we give gold -1, art -1, equity -1, and real estate -4, because that's a lot bigger, it has a lot higher to fall. So if you do this by the end of the 21 years, we'll see this is the point at 29.2% is the point at which Bitcoin becomes bigger than bonds and fiat money. And at that point, it's also, the other things, gold, art, equity, real estate, they lose their monetary premium, at least most of their monetary premium. They're held for their utility or for their return, not as a form of saving. So at this point, Bitcoin would be about 260 compared to fiat and bonds of 140 and 120, which is where they are right now. So this is not, I wouldn't say this 260, I wouldn't measure it in terms of trillions or billions. I think it's more useful to just think about it in terms of the change from now until then. What do you think of that?
I I'm not quite sure I'm following what's the point of this, because in 21 years, you know, yeah, I'm not quite I don't even think your units aren't nominal, your units are real, so I guess you're calculating
I'm just
something
looking
in
at them related to one
2024
another.
I don't get it, so I don't have a reaction because I don't understand what you're trying to
What I'm
say
trying
or
to say
what
is that we're
you're
not we're not measuring them in terms of dollars today or tomorrow. We're measuring them just in terms of ratios to one another. So at this point, bonds and money, if you add them together, are worth as much as Bitcoin. So imagine a world in which if we have 29% outperformance of Bitcoin outperforming bonds and money by 29%, which so far has been doing more than that, because so far bonds are down over the last 2, 3, 4 years, 5 years, and Bitcoin's massively up. So it's been at least double 29%. But if it keeps carrying this on for another 21 years, then at 2045, Bitcoin's bigger than bonds and money at 29% of growth.
well, again, I would encourage you to to actually take the Bitcoin 24 model, find a way to crank your assumptions in and spit out the nominal map or the heat map of the asset distribution in the year 2045 and show that versus the one that we've created. Because if you want to go back to the one that we have in our base case or that
Yeah,
I
but I
have,
mean, yeah, here it is.
you can debate it one way or the other, but here in this base case, we're assuming that even if Bitcoin grows at 29% ARR, and that's a nominal ARR, right? Then bonds are actually going to be a larger asset class than Bitcoin in the year 2045. And and equity will be a larger asset class and real estate will be a larger asset class. So we're only forecasting in this base case that Bitcoin will be much larger than gold. We're not forecasting it would be larger than the class of all equities or the class of all bonds.
I did it.
So
I
I
made Michael Saylor sound bearish on Bitcoin next to me.
it, yeah, so I don't really know. If you want to generate your own forecast, it has to be in nominal terms in the year 2045. Then we can compare it to this one and talk about the difference. But I mean, the whole point of that model is everybody can crank in their own assumptions and spit out result in nominal terms over the next 21 years, and it gives you charts and it gives you the heat maps, and you can decide. I mean, it seems to me, I think that the S&P index and that equity indexes will continue to appreciate, and I think if you look back, the money supply versus the S&P has been pretty correlated. So if the M2 money supply expands at 7%, I would expect that equity will track that. And here, this is a bit bullish. There's an assumption here that equity will outperform the money supply, but you can come up with a bearish assumption where equity underperforms the money supply. I mean, clearly this chart is we're a bit bearish on bonds. Bonds aren't growing as fast as an asset class. Real estate is tracking. Equity we're kind of bullish on. Art we're a little bit bullish on. Maybe we shouldn't be. And then gold we're very bearish on, and Bitcoin we're triple bullish on. So that's what this assumption is. I don't think the bonds are going away, Safe. I don't. I mean, I think that I don't really think. I don't. I think as long as we have nation states and we have cities and states, they're going to borrow money and they're going to keep expanding the sovereign debt. And I think there'll be corporate bonds as well. So I'm not. I don't think they go away, and I don't think equities go away unless we lurch into a socialist, more communist type state. I think the argument in favor of equity values going away is you have to basically argue that the state will move to expropriate, regulate, and tax out of existence the equity values, and they could. So this is kind of a bullish on capitalism, right? This forecast, like companies invent stuff and they're able to keep their earnings, right? So it's a fairly bullish on creativity, very optimistic about technology innovation, optimistic about capitalism, optimistic about transformation, pessimistic about the opportunities for gold. I don't, art's a small thing. I don't really know one way or the other, but at the end of the day, it doesn't really matter that much given the fact that my advice, if you're a Bitcoin maximalist or a Bitcoiner, is you shouldn't be investing in anything other than Bitcoin. Right? Right? Like, right? I mean, Bitcoin you've got an answer. There's one winner. Everybody else is a loser, right? And so the question is, are they going to lose big or lose small? And if you came to me and said, "Oh, I'm going to find a strategy to short the bond market," I would say I don't suggest that either. You might lose your shirt. So I don't know how to short, or I don't know it's very wise to be shorting most of these things.
Well, I mean, buying Bitcoin effectively is shorting them in a way.
Yeah. The takeaway from this is that Bitcoin can win, and the world doesn't necessarily have to turn upside down. Right, but when Bitcoin is the global monetary asset or the global monetary index, it still may not be as big as equity capital. It's just going to become much, much more material than gold and much more useful than gold. And, the dynamic between all the rest, it's a function of, are states running deficits or not, and how do they handle their issues? And this is an optimistic forecast. If you come up with a pessimistic forecast, is the only thing that's left is Bitcoin, right? Like, for example, if I have a pessimistic view of a nation state, the stock market collapses and the equity goes to zero, and the currency collapses and the money supply is not worth anything, right? And maybe the real estate isn't worth that much because the rents aren't worth that much. But the challenge is, it's I mean, it's easy to forecast that for Venezuela or Cuba or North Korea or in Nigeria, right? You can forecast it for a small developing country that's either poorly run, mismanaged, or communist, or dysfunctional with hyperinflation or a war zone. It's hard to forecast that for the entire world, right? If the entire world, imagine a forecast where all the currency of the world goes to zero and all the companies go to zero. Well, that's a big problem. So I'm not thinking that. And this is just a global macro model. It's not a micro model. So in the global macro model, the assumption is the world government works, all these governments work through a bunch of issues, and they eventually figure out how to not make things much worse. And then technology advances, and we get humanoid robots, and we get AIs that actually do useful thinking. And then we figure out how to, unleash, the power of 100 million AIs to make the world a better place. And there'll probably be companies that make a fortune, the next Facebook, the next Google, the next whatever, and their equity market caps will be quite high. And meanwhile, capital will be created by human productivity, and a lot of that capital will flow into Bitcoin because Bitcoin's digital capital. Some of that capital will flow into real estate and equity. I mean, companies are going to overcapitalize. Like if Apple makes $500 billion in selling the iPhone, and then they pour the 500 billion back into buying their own stock, right there, they're kind of supporting Apple as a long-term store of value capital asset by pouring their 500 billion into Apple stock. So I mean, I think we'll see that. Now, the conventional view of capital is I pour all of my cash flows into buying my own stock back. And that's what Meta's doing right now, and that's what Apple's doing right now, and other companies do some of that. The the unconventional view is I take my cash flows and I buy Bitcoin, right? And so if the world goes completely rational, digital, then we will demonetize equities faster, right? Like, and if the world stays very conventional, we will continue to monetize equities and real estate to a greater degree, right? And sovereign debt and bonds, right? I think sovereign debt, real estate, and equity are conventional capital assets for corporations and big institutions and the like. And Bitcoin is the 21st century novel capital asset.
Principles of Economics, my complete guide to understanding economics, is now available in hardcover, audiobook, and ebook from Saifedean.com, Amazon, and many more booksellers worldwide. And now I am also teaching a course based on this book on my website, Saifedean.com. Principles of Economics will run the whole academic year, from September to June, and will have a new lecture every 2 weeks, as well as weekly live online discussion seminars open to learners from all over the world and from all walks of life. Whether you're a student, a professional, or a retiree, you are making economic decisions every day, and this course will arm you with the wisdom of centuries of economists to improve your economic decision making. You'll also get a free book of Principles of Economics if you sign up for the course. Go to Saifedean.com and sign up now.
And the interesting question, right, is at what rate does Google decide that they're going to start to buy Bitcoin with cash flow instead of buying treasury bills with cash flow? Or if I generate $1 billion a month and I'm a big tech company, I can buy treasury bills, probably US treasuries short dated, or I can buy my stock back, or I can buy Bitcoin. And as a practical matter, I don't really think there's that much else you could do. Oh, you could dividend out your cash flow, right? And so, I mean, those are really your choices for the most part, and that's what the big tech companies do. So the interesting question is, at what rate do I go from buying my stock back, where I'm basically capitalizing my equity, or do I buy the treasury bill, which is capitalizing sovereign debt, or do I go to buy Bitcoin, which is digital capital, capitalizing in Bitcoin? And that's a regulatory issue, and that to a certain degree, and that's also an issue of corporate finance doctrine. Like, when will business schools start to teach CFOs that they should take all of their cash flows and buy Bitcoin with them, or half their cash flows and buy Bitcoin with them? And if that changes, then Bitcoin monetizes much faster. And if we're traditionalists, right? Like, right now, the big bulge bracket banks, they can't custody Bitcoin, buy Bitcoin, or sell Bitcoin. So that's a huge impediment to Microsoft, Google, Apple, Amazon adopting Bitcoin as their capital asset, right? You're not going to see mega conservative corps do that until they can wire $1 billion a month to Citi or Bank of America or JP Morgan and just have it converted and held in a capital account. So when that happens, when SAB 121 gets repealed, or when there's support for banking Bitcoin in the traditional banking system, I think that accelerates the um, uh, the monetization of Bitcoin, and it accelerates the demonetization of equity and debt. But, so you can fixate on saying, "Oh, well, this is all just about, using Bitcoin instead of sovereign debt as a capital asset." But I could argue that right now Microsoft, Apple, Google, and Meta have already decided they're not using sovereign debt as a capital asset, right? They decided 20, 30 years ago that debt is a bad capital asset. So they're really monetizing their own equity, but either by buying their equity back, or they're overpaying for other equities when they do these mergers and acquisitions. If you're a CEO and you've got a lot of cash, you either got to go buy other companies, and they overpay. 90% of acquisitions are they overpay and they're diluted, right? So we're in a way we're monetizing private equity, or monetizing all sorts of other equity, or we're monetizing public equity. And if I didn't have to, if I didn't, yeah, I think Meta is going to do a $55 billion share buyback. Well, what if I bought 55 billion of Bitcoin instead of 55 billion of my own stock? Right? Yeah. By the way, and here's an interesting one. The stock becomes a derivative of the Bitcoin if I capitalize on the Bitcoin. So if you're doing this macro model, you could say, well, that means that, the 55 billion goes to Bitcoin and it goes away from Meta, but it's not quite, because if Meta buys Bitcoin, then the market cap of Meta probably increases by $200 billion. And so the equity gets larger. And then if you're really sophisticated, you would be saying, what percentage of the equity is backed by the Bitcoin in that model, which we haven't worked through that second order issue. Right, but you could imagine, like, a rational world is Amazon, Microsoft, Meta, Apple, they all buy Bitcoin with their cash flows. I mean, Apple would be worth an extra $1 trillion, right? If Apple basically started buying 20, $30 billion a year of Bitcoin, they spent 500 billion on their stock. Where would Apple be if they bought 500 billion worth of Bitcoin right now? I mean, granted, it was over a 10-year time period, but if you look at that, right, how do you increase the market cap of Apple or Meta by a trillion? And the answer is you start to take your cash flows and your treasury, and then you buy a capital asset that's plus 40% a year instead of one that's minus 4% a year. And when that happens, you can see in our macro model, the equity market's going to look good, right? That's going to put a boost in the S&P and the NASDAQ and the Magnificent Seven. So it's not, you know, I guess my point is I don't want to be a doomer like Bitcoin good, everything else bad, because the truth is you could say Bitcoin good, equity bad, and bonds bad. But if I actually back the bonds with Bitcoin, and if I back the currency with Bitcoin, and if I back the equity with Bitcoin, then they're all going up. Right. So it's like just Bitcoin better, and everything else is actually going to grow. And and that's the argument for Bitcoin just makes the world a better place, right? It's the constructive, cheerful, progressive, grow out of your own problems with a good technology, vision, as opposed to, you know, this nation is going to melt down its currency and its banks are going to melt down, and we're all just going to jump on a lifeboat. So it's
I don't think that is the case. And in the Fiat Standard, I discussed this in detail. And I think it's I don't see it as necessarily having to be something that is disastrous, because I just think, as you described, um, people are just going to start holding more and more Bitcoin. Now, I mean, you're the one who said it's going up forever. Going up forever means eventually it's going to reach a point at which it's going to be larger than pretty much everything. It's just going to keep going up. Yeah. So this is, if you see here in the yellow, these are your projections. But then I think the comparison is in terms of percentages. In your projection, Bitcoin remains at around 7% of global assets, and money and bonds are 12 and 21% in real terms. So here are three different scenarios that I put up, which I thought would be
Okay.
interesting. So in the first scenario, Bitcoin goes up 25, and art, gold, real estate go down, and equity go down -1 and -4. Oh, and to add, I changed a little bit the starting point. So in your case, the starting point for gold, for instance, for equity, you had it at 115 because you counted all equity markets. I counted only 20 because I think that's roughly what's the monetary premium in equity. That's what you would expect to go away. You wouldn't expect equity markets to disappear. You wouldn't expect art to disappear, but you could say that it could go down from that you could say that from the $18 trillion in art today, about five of them, I think that's a conservative estimate, but about five of them are just monetary premium. Everything else is people buying it. 13 are people buying art because they like it, not because it's an investment. And then real estate, we'll drop it to 100. And then bonds at 130, 40, and money at 120. Now, if you're thinking of it this way, then we get to a point with 25% Bitcoin, and the other assets shrink or stay roughly constant. Then Bitcoin gets to 30% of all assets in 2025, while bonds are 34 and 17. But if we do 29% for Bitcoin, then Bitcoin overtakes bonds and money. And if we did 35, then it's triple as big as bonds and money in uh, 2045. So that's not entirely out of the realm of possibility. Bitcoin can do 35% over the next 21 years. And if it does that, it's a lot bigger than money and the bonds. And that's not necessarily a bad thing. My question is, if this happens, Bitcoin's witnessing a phase shift. Bitcoin is 62% of global money markets, or of store of value in the world. At that point, a child isn't an adult isn't just a bigger child. There are fundamental functional things that change. And so when you go from an asset that's $1 trillion, or less than 1%, or less than a half percent of global capital markets, to something like 60% or 50% of the store of value market in the world, well, that's going to make you the most liquid asset. So at this point, wouldn't you think that that's going to undermine demand for bonds and government money?
No, I got I
Like, why would you lend money to bonds? You were just saying how Apple wouldn't lend, you wouldn't lend them. Well, if everybody figures this out, and I think in 21 years, eventually I think they will. In 21 years, why would anybody want to lend to a government? And of course, I am biased here about bonds. I don't think it's going to be a doomsday scenario. I think it's going to be utopia when we just start saving in something other than government coupons.
I don't buy into the notion that everyone else must lose for us to win. I just think I think that's that these ideas that I got to find the loser are just not they're non-constructive and pessimistic and cynical, and I don't think they're necessary. So for example, like I think people like art. I think if the, I think that the currency supply will keep expanding. It's been expanding at 7%. I think it'll keep expanding. I think the value of art or the price of art will go up, right? I think that the price of real estate will go up. I think that people companies will keep getting bigger. So I think that governments will continue to borrow money, right? And I think that some governments will succeed better than other governments. But as long as there are companies, they'll keep selling equity.
Okay, they'll sell equity, but I mean, why bonds? I think equity, yeah, it makes sense, but why bonds? Because I mean,
Okay, well, it's
the value proposition of bonds is that you're not getting equity risk. Well, Bitcoin doesn't have equity risk, and it's a lot better.
yeah. So the point is that if Bitcoin goes up 29% a year, it's still only 7% of the world capital. So it's like the fact that I own an expensive apartment building in New York City doesn't mean that the United States government isn't gonna borrow money, and it doesn't mean that no one's gonna loan the money to the US government. So I just don't follow you, right? You don't Isn't a 21-year-old gonna borrow money to buy a house? I mean, like, what's big like, if I'm a 21-year-old and I wanna buy a car and I don't have the money, I'm gonna borrow money to buy the car. So there you go. There's a piece of debt. It's not going away. If I'm the city of New York and I wanna build a new tunnel, I'm going to borrow money to build the tunnel, right?
Well, but I mean, the tunnel can be built by private companies. They can borrow, businesses can borrow, banks can lend. I think w- private lending might continue, and government lending I see as being the real potential thing that's going to be disrupted here, because the reason people look for bonds, as you said, remember earlier you said that the risk-free rate, as people think of it in fiat markets, is that it's buying the bonds and then the return you get with bonds after taxes. But if they figure out that that's not risk-free, and over the last 3 years or so, you lost something like 30-40% um, going into this risk-free asset. So if this keeps up, and you look at the fiscal situation, it's not looking very promising, whether it's in the U.S. or in other places. So you would expect continuous underperformance for government debt, and now you have an alternative. I think this is really the incredible thing, which is why it's different from real estate in New York, because not everybody can buy real estate in New York. You have to have an enormous amount of capital and connections and understand how to run real estate in New York, and there's an enormous cost to holding it and running it. That's not the case with Bitcoin. With Bitcoin, you just need to understand how to hold your private keys, and then you can hold it. So why would you buy real estate in New York unless you had a very good reason to do it as an investment, but not as a store of value?
We can't I again, so
You're free to disagree, of course.
People wanna live in New York. So my my point is you're making this a black and white. People want to live in New York, so they're going to buy an apartment in New York because they wanna go to New York and they don't wanna not live in New York. They're gonna buy a house, they're gonna buy a yacht, they're gonna buy a plane, they're gonna buy a car, they're going to buy a share in stock in a company because they wanna own the company. They're gonna buy a sports team because they wanna own the sports team. They're gonna buy a Picasso because they want to own the Picasso. So the issue is those assets aren't going away. The only They're gonna buy a ranch in Texas because they want to say, "I own a ranch in Texas." What's happening is there's competition entering the market, and Bitcoin is a competitor for that capital. So, I think we could probably just agree that Bitcoin competes with it competes for capital, and it's a good competitor. And if I had a choice, I would probably prefer to own the Bitcoin if my primary goal is store of value or long-term capital preservation, and that's just going to drive down the price it's gonna make the building cheaper. Maybe it'll make the sports team cheaper. It'll make the Picasso cheaper. Maybe, in a bond, it'll make the bond cheaper, which means the interest rate will be driven up, right? In a competitive market where you have a free market and no capital controls, right? Then in that case, take example, right? When you have a weak currency, you have a high interest rate. You have to pay higher interest rates to get capital, right? If there's no capital controls. So I think we could say that Bitcoin is a competitor for capital against all these other assets. So if you were to say, Mike, I think that the P to E and the S&P will go from 22 to 18, yeah, I would agree. Like this will put pressure on P to E ratios. This will put pressure on cap rates. Instead of a cap rate of 30 on real estate, it might go to 20 or it might go to whatever. If you were to say, Michael, I think that, borrowing money for 30 years at less than 4% interest, seems, you know, fairly cheap, like too cheap. Like you shouldn't loan money for that rate. I would agree. I think that long-term interest rates in the fiat world should go up, right? And if we come back to free market Austrian economics, if you really have a free capital market cross borders, and if you really have a free capital market asset class to asset class, then over time, the thing that's priced too cheap is the interest rates that are too cheap, they're gonna rise. Interest rates that are too high are going to fall, right? Assets that are overpriced are going to find demand wane. Assets that are underpriced are gonna have a lot of demand. And li li like, what do I think's more likely? What's more likely is that instead of a municipality being able to borrow money for 2 or 3% interest, they'll have to pay 6, or so the rates will creep up, and then at some point, somebody will say, "Wow, this is really expensive. Maybe we shouldn't do this thing." Right? If interest rates will creep up and, capital expenditures will that are funded by that cheap credit will decrease. And in the free market, you see that happen. Like right now in the, if you're a small company, a mid-sized company, or if you're a private real estate developer, your cost of capital is 12 to 14%. And so, like, if you talk to people that are thinking about developing a hotel or developing any real apartment building, if your cost of capital is 12 to 14%, there are a lot of projects that just don't happen, right? But the cost of capital for the government is not 12 to 14% right now. The cost, depending on where you are, right? And in the Western world is much cheaper. So a lot of expenditures get green lighted under the theory that it's really cheap and we can afford it. So if capital flows from these other assets, I mean, the capital is going to flow from the GameStops of the world to Bitcoin, right? There are a lot of companies that have overpriced stocks, and this will put pressure on their stocks, and they won't spend the same kind of money. I think there's a lot of real estate that's overpriced. It'll become more affordable. What really happens is the pure capitalist, if I just had $10 billion just to invest and I'm bidding for apartments or houses and I'm paying double what they're worth or what they're worth in utility value, that capitalist is going to say, I don't need to do that anymore. I can buy Bitcoin. And so they're gonna take their capital, and instead of buying up all the apartments in Canada or all the multifamily user buildings or multifamily buildings wherever, and then doubling rents, they're gonna pull their capital out, and they're gonna buy Bitcoin, and then all of those assets are gonna fall, and if those asset values fall, the rents will fall.
And then the renters will buy.
And we're going to demonetize assets with utility value, and they'll fall toward their utility value, right? So gold jewelry will get cheaper, to your point. We agree on that. Apartments in Canada or the US or New York will get cheaper because anytime someone's holding a bunch of real estate they don't use because they want to land bank it or something, they've overpriced it for someone that does want to use it. So I think that that'll happen, and I think that bonds are overpriced right now. We can agree on that, and Bitcoin is a competitor, but it's not a totally free capital market, and it's not unregulated, and so there are some, like, organizations that have to use that as a capital asset, they can't change, so it'll take a while. It could take 20, 30, 40 years, right? Who knows how fast that'll happen. But over time, if I have the choice of capitalizing using a piece of sovereign debt or a corporate bond, like I'd much rather have a corporate bond that yields 12% interest than yields 4% interest for sure, right? But so there are a lot of corporate bonds, the triple A investment grade stuff that actually pays not that much because they're pegged to the sovereign interest rates. So I think that, if I have choices, you're probably gonna sell that stuff. You're gonna sell credit. You're gonna sell the bond instruments, and you're gonna buy Bitcoin. The result is the bonds will fall in price. It'll happen in some kind. I'm gonna be constructive and progressive and say, I think it'll gracefully progress. The price will gradually fall. Companies will be disincentivized. Like, right now, who issued that debt, Saifedean? Apple. Apple issued debt to do what? Apple issued debt to buy back their own equity, and it's pegged to the US sovereign debt rate. Well, so what if Apple buys Bitcoin and doesn't issue debt, right? You start to see now a different thing. They're currently supporting their stock price by taking on debt and buying the stock back. But what they could do is support the stock price by holding a capital asset, Bitcoin, and not issuing the debt. So maybe you'll see less corporate debt. Maybe you'll see less different types of debt. Maybe you'll see less. And at some point, if the price of the debt falls and the interest rates rise, then you would think if the US government had to pay 12% interest right now, don't you think there'd be a lot more consensus to cut costs? May maybe there'd be consensus to raise taxes, right? That's a political thing, which is kind of above our pay grade, right? We don't get to decide whether they cut costs or raise taxes. But what we can agree is the debate over running deficits would get much more pronounced, and I think that over time, uh, it's gonna be that these corporate these governments, right, and sovereign entities and nation states, and not just nation states, but states and cities and counties and agencies, all of those will presumably act more rationally as the cost of capital increases. And that's what this is all really about. It's introducing a rationality virus. And I would argue the best thing for the world is if the rationality virus spreads gradually, progressively, gracefully, gently. Because when the rationality virus, hits you, like you saw what happens in Greece with austerity. When you get this austerity lockdown overnight, you get riots in the street and you get human misery, and the government, collapses. And when the government collapses, the hospitals stop working and the ambulances stop working and the police force stops working. And so I'm not in favor of too fast. I'm in favor of gradual, graceful, gentle, kind spreading of the rational virus, which I think will get us to, a different place. But what is that place? It's hard to forecast. I mean, the world's very complicated, very complicated.
The Bitcoin Standard podcast is brought to you by CoinKite. CoinKite are my favorite makers of Bitcoin hardware. They produce the legendary OpenDime, the first Bitcoin bearer asset, as well as the reliable cold card hardware wallet, the excellent stainless steel seed plates for storing your seed phrases, and the block clock. Now, CoinKite have produced the Sats card, a card the size of a credit card which can store Bitcoin and works great as a gift. CoinKite have just produced a limited edition gorgeous Bitcoin Standard Sats card, which carries the Bitcoin Standard logo, and you can get it from coinkite.shop/Bitcoin Standard. Use the code Bitcoin Standard to get 5% off your purchase. This podcast is also brought to you by the Bitcoin Way, your professional Bitcoin IT team offering you personalized, secure, and comprehensive solutions for every step along your Bitcoin journey. The Bitcoin Way offer live concierge service to guide you with your Bitcoin cold storage, running your node, privacy best practices, inheritance planning, corporate strategy, and multi-sig solutions. They don't touch your coins, they guide you through the process of acquiring your coins and securing them. If you'd like to make your setup safer and more reliable, book a consult with them and see what they have to suggest. If you want to give someone the gift of Bitcoin, get them this professional service that will ensure they start off knowing exactly how to manage their coins and not lose them. Go to thebitcoinway.com and start Bitcoining more confidently.
Well, I mean, your actions are certainly increasing the speed. You may say that you want it slow, but you've bought what so far? $8 billion worth of Bitcoin. That's a lot of Bitcoin. That's pumped the price significantly. I mean, that's not a rounding error in the market cap of Bitcoin. But I think, allow me to just say, so you asked the question of how's the guy going to buy a house? I think the key thing to keep in mind is, first of all, because people are no longer using houses as saving accounts, the prices of houses goes down. And so you're only competing with people who want to live in that kind of house, in that kind of neighborhood.
I think
You're
that's
not,
an awesome outcome.
absolutely.
We love that. That's great.
Absolutely.
And
And
I agree with you.
you're not competing against BlackRock wanting to use this house as a store of value. You're competing with people of your social class in your kind of job who want to buy this house, and that's going to make the house a lot cheaper. Now, Flip side of the coin is that your money is appreciating. So we're in a different world where you don't just have to hold money that's depreciating, you can hold Bitcoin. And so in this case, think about a 21-year-old, 25-year-old who wants to buy a house. Well, I mean, if they started saving when they were born, if their parents started a saving Bitcoin wallet for them, and they started stacking sats and Bitcoin appreciated over those 25 years, and the price of houses is going down, I think we move to a world in which people just buy things but with cash. And at that point, it's both because it's easy for you to afford the house, but also it's because it's very hard to find people who are willing to lend a random 25-year-old for a house when they can just buy Bitcoin. So we see rates rise, and we see that put people who are in debt in serious trouble. And then we see defaults. But I don't think it's catastrophic because we're going to see abundance. We're going to see houses becoming cheaper. We're going to see everything becoming cheaper. And we're going to see less and less government waste and destruction. I think that's the cherry on top.
I hear what you're saying. I'm a Bitcoin maximalist, which means I believe Bitcoin is an instrument of economic empowerment, and I'm very pro introduce Bitcoin to the world. I feel that strongly. I don't share your strong sentiment that credit is bad. Like I am not against these the rest of the things in the world. For example, if you want a car loan, you want to buy a car and you want to pay for it over 3 years, I don't have a problem with that. I feel that Bitcoin is good, but I'm not going to take the position that car loans are bad. I'm not against credit cards. I'm not against car loans. If you're a 22-year-old or a 28-year-old and you want to buy a luxury apartment and you don't, it's all nice. Yeah, if your parents gave you a lot of money, you can buy it. But what if you're an orphan and you're 28 and you want an apartment? And I think it's fine to have a 10 or 30-year mortgage to buy an apartment. I'm not here to eliminate mortgages or change the banking system. Banks are fine, credit cards are fine. If Ferrari wants to sell a Ferrari and give you a 60-month loan for 3% interest, okay. And as for currencies, I recognize the tragedy of fiat inflation, but I'm I'm not dedicating my life to stopping it. I'm dedicating my life to spreading the gospel of Bitcoin. So what I think is we're still going to have hyperinflation in some countries, right? Like I don't think I'm not realistically thinking I can stop that. I think that there's going to be some we've got this 7% currency growth in the US dollar over about 100 years. Will it get better? Will it get worse? Will it stay the same? My base case is it's about the same, right? It's not better, it's not worse. If it gets if it gets better, the optimistic case is Bitcoin backs the dollar and Bitcoin introduces rationality in the political process in the Western world, and we decrease that. But that's above my pay grade. Like what happens with the dollar and, the Chinese monetary policy and Russian monetary policy and US monetary policy and Euro monetary policy? Those are all things that other people have control over. And I don't none of my actions are predicated upon the world dramatically changing in any of those ways. It may, if it does, maybe okay, but I really think that if you're looking for a categorical evil, the categorical evil is people can't buy Bitcoin. The failure of Bitcoin, the blocking you from owning Bitcoin, that's the evil. Like I will lecture a 25-year-old on why they should have some Bitcoin, but I'm not going to waste my breath lecturing them on why they shouldn't get a 36-month car lease for a car that's 20% more expensive than they can, you know, you should buy a used car with your cash or you should buy a new car with a lease. It's like I'm not going to take a position on that, right? Other people might. By the way, it's fine for someone else to be the expert on whether or not municipalities should finance their expenses with municipal debt or not. It's just a different life pursuit. And so my life pursuit is, advocate Bitcoin and then how do we get Bitcoin spread throughout the world? And I think that everything else is complicated and it's suboptimal, and we could talk about 1,000 suboptimal things, and my answer would be, well, Bitcoin probably makes them less suboptimal. Every single thing you could point out, I could say cities are better if they have some Bitcoin. Your family's better if they have Bitcoin. The company's better with Bitcoin. The country's better with Bitcoin. The currency's better backed by Bitcoin. The debt should be backed by Bitcoin. The equity should be backed by Bitcoin. All those. But I don't think the things go away. And I think that some people will reject us and they will reject Bitcoin for a long, long time to come. And so I think it's better if you don't predicate, your life's work on one of those other things happening, because that's a heavy lift.
Yeah, I should say I'm not advocating for this, and I'm not saying that this is something that should happen. I'm just essentially running the numbers and saying at some growth rate, this inevitably happens where Bitcoin becomes the largest liquid asset. I think we demonetize all these other things that we were talking about, and that makes them cheaper and makes equity markets more efficient and less prone to bubbles. But I think it's just, this isn't me imposing my preference. I just think borrowing is going to be harder when people who can lend can't just hold Bitcoin. So I'd expect fiat interest rates to go up significantly. And people, instead of borrowing fiat, they're going to start stacking sats so that they can afford those things. And I don't think that that's necessarily a bad thing. I'm okay to live in a world in which that doesn't happen, but I just see this as being inevitably the outcome of number going up as long as the Bitcoin price continues to go up. And I realize, yes, some people are going to oppose this. Some people are going to resist. They're going to want to hold on to bonds. They're going to force people to stay in bonds. Their pension funds are going to be forced to continue to buy more and more government bonds. But again, Bitcoin's not optional. That's just going to mean that these people are going to get poorer. So the people that are exploiting this system, that are preventing you from staying out, from getting out of it, are going to make you poorer. And then you're going to be a lot less likely to benefit them when they try and profit from you from inflation, because the amount of money that's going to be held by people who hold cash and buy bonds and so on is going to, in my opinion, go down. So, of course, I understand that you disagree, and that is totally fine.
I don't disagree in principle what you're saying at all. I just think over 30 years, there's this dynamic going on where you've got a rational progression of Bitcoin. If Bitcoin is 0.1%, let's take my base case. It goes from 0.1% to 7% over 21 years. And I who knows what happens for the next 10 or 20 years. I don't know. But as that happens, as you introduce that rational digital capital, I mean, if digital capital is an alternative for every corporate capital allocator and for a CFO, and if it's an alternative for an institutional investor, and if it's an alternative for a family or an individual, and if it's an alternative for a government, well, then, what you see is the difference in cost of capitals across those asset classes should, in theory, start to converge, right? Because there should be capital should flow from the place it's treated worst to the place it's treated best. So if the returns in Bitcoin right now are 45 to 50% ARR and they're only 12% in the S&P, then those two have to they have to converge over time. That doesn't mean immediately, and it doesn't necessarily mean completely, but you've got one asset, $1 trillion pool of money yielding 50% and $100 trillion pool of money yielding 12. You could easily imagine when Bitcoin's 100 trillion and, whatever the equities are 200 trillion, then those numbers start to look like Bitcoin's at 22% and the equities are 10 or 12, and they're converging somehow on each other, because there's going to be the arbitrage opportunity, right? An intelligent CFO will think, maybe I'll trade the one for the other, but think about what happens if every CFO simply capitalizes their company on Bitcoin, if half of your if half of your enterprise value is Bitcoin and the other half is your operation, if Bitcoin goes up 25 or 30% a year, doesn't the half of your enterprise also go up by 30% a year? So you can see that if equities capitalize on Bitcoin, there'll be a convergence over time. And the law of large numbers says that Bitcoin's not going to grow 4x this other large pool. It's going to grow 3.5 and 3.2. And I don't think it becomes exactly the same because Bitcoin is more efficient. My model, I've said before, is like I feel like, you know, if you look out in the indefinite horizon, if the money supply or currency in dollars expands at 7, 8% a year, and if you start seeing the S&P index expanding at that amount or that amount plus, it'll either be that amount or that amount plus 2 or 3%. If that's what happens, then Bitcoin should be growing 8, 10% faster than that, or 8% faster with more volatility. But you can imagine a world where Bitcoin is 20 vol, 20 ARR, and the S&P is 12 vol, 12 ARR, and the currency supply is 8% expanding. And of course, again, that's the bear case, or the bull case. The bear case for equity is that equities underperform the currency supply. And that comes down to tax policy. I mean, if you're looking at the primary levers, right? The case for equities outperforming the currency supply is innovation and productivity. If you're really, the invention of robots and AI, I if you do that, then a company basically has, you could have like 100 employees in the company doing the work of 10 million people with just AIs and robots. So in that case, you've got a lot of equity value and not a lot of cost, right? So the bullish case is you invent new stuff. Now, what keeps you from outperforming the currency supply? Tax regulation, right? So taxation and regulation that drives up your cost one way or the other. And those are political decisions, right? That take place. So it seems like the world's been, the S&P is like, what is it like plus 8, 9% a year, and the currency's like plus 7 to 8. They're almost equal, but maybe S&P's up 1% more. Well, I think we can't expect Bitcoin to perform 50% ARR for the next 30 years. I mean, because then it would be everything and there's nothing left. So what you got to expect is that it's converging toward that, but not necessarily ever reaching it.
Yeah, I think it's inevitably going to slow down. And if you look at the last 15 years, it has slowed down because it takes a lot more money to pump it when it is bigger because you need more and more hodlers. Could reverse. I think we could see some kind of S curve adoption where things shoot off, but I don't see that as my base scenario. I think we're always going to have this kind of market mania because of people getting in with leverage and price rising and price crashing. um, I think over time this will moderate, but eventually I just think it goes up. And yeah, I agree with you. I think Bitcoin should back the US dollar. If you care about the US dollar, you want the US dollar to survive. But I just also think that in that kind of world, you no longer have a Bitcoin printer. And I think in that kind of world, governments, rather than competing over who can run their printer better, it becomes a competition about who can have a bigger amount of Bitcoin. And then you start financing government spending from the giant stash of Bitcoin that you have. And so I think we could see a world with Bitcoin where because governments can no longer borrow because they can't have a printer that just prints the money that they borrow, they need to act responsibly. And governments that don't act responsibly get into deep trouble, and governments that do succeed and take over from the unsuccessful governments. And so we start seeing governments competing not through devaluation, but governments competing through accumulating a larger cash balance.
And that's a triumph of the rational mind virus.
Absolutely.
You're describing rational governments, and I agree with you. I think that's a beautiful thing, right? And we've seen with individuals that discover Bitcoin become more rational. right? A lot of the Bitcoin maxi, mantras, and tropes and are actually rational observations. So I think Bitcoin rationalizes things. It's rational to minimize waste, maximize efficiency, stretch out your time horizon, minimize counterparty risk, maximize optionality, right? These are all things that happen, right? And so I think that the Bitcoin, as it spreads, it will introduce rationality. It will infect individuals, then it infects families, then it infects corporations. Like a corporation that adopted Bitcoin as capital asset, at the end of every quarter, they would say, "How much of this cash do we want to dividend out and pay 30 or 40% tax on? How much of this cash do we want to use to buy our equity back? And do we have too much equity outstanding? How much of this cash do we want to use to buy small, mid-sized companies and do mergers and acquisitions? And how much of this cash do we want to convert to Bitcoin?" Okay, and that's a rational set of decisions as opposed to the irrational decision, "Oh my, we just have to get rid of it because we know we're burning it if we just put it in the bank account." So I think the companies will get more rational as Bitcoin spreads. And I think countries will get more rational because they'll have more optionality. In that Bitcoin 24 model, right? We didn't just create the macro model. I mean, the truth is the macro and the Bitcoin model, they're interesting, but you know, no one's there's not nearly as much emotional attachment to a generalized global asset class. So what's really interesting is the micro models, the fact there's an individual model that says, this is what happens if you adopt the Bitcoin standard and move to a place with no income tax. You're a triple maxi, right? And that's a family decision that you make, right? This is what happens if you actually take a mortgage and buy Bitcoin with it, right? So that the micro model for an individual has a lot of emotional gravitas. And then there's a corporate model, a micro model for corporations. And it shows what happens if your company sweeps its cash flows into Bitcoin. And you can adjust that. And you can make assumptions about, okay, I have a company. What if I sold half my equity and bought Bitcoin with it tomorrow? Your company's worth whatever, $100 million. What if you sell $100 million of stock and bought 100 million of Bitcoin and you held the Bitcoin for 21 years? Like now you can look at that. That's very actionable. So I think that the corporate model is interesting. And then I think we created these nation state models, but we created one for an indebted nation state. It's like you're an indebted nation state. What happens if you start to buy Bitcoin? Or okay, you're in debt. Well, what if you issue debt to fund operating losses? Generally not a good idea. What if you issue debt to buy Bitcoin? Actually turns out to be a pretty good idea, right? I mean, you can say debt's bad, but that's not bad. If I issue $3 billion of debt at 1% interest and then I buy Bitcoin with it, that's how you outperform the S&P 500. It's only bad when you issue $3 billion of debt and then you spend it on things, spend it on expenses and have nothing to show for it. If you buy $3 billion of consumable goods, then it's bad. So that model, has tabs, and you can run the indebted country, indebted nation state model, or the rich nation state model, or you can run the United States model, or you can run an institutional model. And I think that that's where you just start to find what you see is, oh my, every time I spend $60,000 unnecessarily, I lose one Bitcoin, and the cost of one Bitcoin is $13 million in 21 years. Now, I agree. I understand you don't like nominal calculations, but I think that nominal calculations are they're useful for people because that's how everybody else in the world thinks right now. 99% of the world is still thinking nominally, and I would grant you that $13 million in 21 years is not going to buy you what $13 million would buy today. But having said it all, if you go see someone and you say, "Look, do you really want to buy that Ferrari? That's 5 Bitcoin. 5 Bitcoin is going to be worth $65 million. in 21 years. You can retire on $60 million dollars might not buy you as much then, but trust me, it'll still buy you a lot, right? And so what that does is when you stretch out people 21 years and then you crank in all of these implications, you start to get a lot more rational, not perfectly rational, but we're talking about time horizons, time preference, and the world's not going to all embrace this immediately, and they're not all going to agree, and it's sometimes it can be challenging to get all of the executives in a company or in a church or a charity or institution or a family or a whatever to get educated and agree. But it's a good it's a good pastime to pursue. I mean, I think it's constructive. I think that we're winning over a lot of people. We're educating a lot of people. They're getting more rational, and in the world that we're seeing, if we look out, every government won't be rational, but we'll have more rational governments than we have now, right? And every decision won't be rational, but there'll be more rational decisions across all these institutions than we have now because Bitcoin is this protocol for economic rationality in the same way that English is a protocol for communication or math is a protocol for reasoning. And we introduce all three of those into the world, and people still say things you hate in English, and they probably still defraud you using math. But, I got to believe that the human race is better off with the spread of the protocols. And I'd be happy to see the human race 5 or 10 or 20% better off by the time I'm done, even knowing that 80% or 90% of what, we regret isn't going away.
Yeah, no, I think just think about it. You're absolutely correct. Think about El Salvador. I don't think it's a coincidence that Nayib Bukele really presents a striking example of a low time preference president who's actually looking out for the long term. And I think, maybe it's not the Bitcoin that made him like that, but at least it was him getting into Bitcoin and also getting into thinking about long term. So there's definitely some kind of correlation there, regardless of which way the causation goes. And I think, currently they've got, what is it, 5,800 Bitcoin, I think, something like $300 million, $340 million worth of Bitcoin. Now, imagine a world in which this continues to go up. They keep stacking sats as long as they can, and they keep increasing their balance sheet Bitcoin, and the Bitcoin appreciates over time. Eventually, they no longer need to borrow. They don't need to buy bonds. Why would they want to give away bonds? Because now they've got, when you get to a point where they've got 15 years expenditure in their Bitcoin cash reserve, which anybody in the country can check, I think this is the future. You've got, governments competing about showing how much they have. Today they are talking about debt to GDP ratio. I think it'll be stack to government spending ratio. That's going to be the ratio that matters. So we've got 15 years of expenditure in our hot wallet, in our cold wallet, which you can check on this address. And then the neighboring country will have 20. And then the people in the country that has 15 might start thinking, hey, maybe we should secede and go join the country with 20. They've got more money. And I think we see this positive competition for fiscal responsibility among governments. So maybe not in our lifetime, but I think there's a good case to be made that this is the trend. This is where we're going. I think Bukele is a trailblazer.
I th- I agree with you on those things. I think that the Bitcoin ethos encourages the dissemination of rationality in a lot of different ways. I think the big idea, the big opportunity, and this is something that the world really hasn't it doesn't have, or it hasn't had for a long time, is the idea that you could have perfected capital and get a return on it. So, for example, like, what's the end game? Say you end up with a bunch of Bitcoin. If you end up with 1,000 Bitcoin and it's worth 10 million a coin in fiat, terms, right, then you've got $10 billion, right, worth of something, in fiat terms. Well, so I think we'll get to the point where the major banks will allow you to deposit the Bitcoin and they'll give you 500, 600, 700 basis points of yield against the Bitcoin. Like I give you a billion, you're the bank, I give you a billion in capital, you loan it to someone that wants to borrow it or short it, they pay you 500 basis points, you give me 400 basis points. That's the role of a banker, right? In a conventional system. That's the way it's supposed to work, right? If it was gold, if I put a billion of gold into your bank and someone else wanted the gold and they paid to borrow it, you're facing both the borrower and the lender. You're putting your balance sheet at work, right? You're going to guarantee their creditworthiness of the lender. I'm not going to loan it directly to them because I don't want the counterparty risk. But if you're a $1 trillion bank with a balance sheet, like a JP Morgan or Citi, I think I wouldn't have a problem giving you $1 billion worth of my capital. And I think that someone else would go to you and want to borrow it. And now the $1 billion is generating 5%, so 50 million a year. So imagine I'm getting 50 million a year in income off of $1 billion, but I've also got it's in Bitcoin, it's not in dollars. So now when Bitcoin appreciates, my capital is appreciating while I generate yield. That's the holy grail. How do I actually, that that's the appeal of, like, I own a company that spits out a 5% dividend yield, and the principal is protected and appreciating. Well, if you think about just pure digital capital, why can't I just hold pure capital without corporate risk and get yield on it? And if that's the case, you've found a way to escape fiat inflation. Like, I mean, like right now, I can get yield if I borrow in yen, or if I borrow in whatever, some other country. Like I go to a country that pays high interest rates, like Turkish lira, and they'll give me huge interest rates, but the currency is collapsing against the dollar. So if you get paid 20% interest and then the currency is losing 30% of its value every year, your real return is minus 10% or something. It's not plus. So the problem right now is if I just hold $1 billion worth of dollars, I get 5% interest, but the currency is losing 7% of its value a year, right? So I've got a negative real yield on fiat capital. Yeah, the real fundamental problem is any of these institutions will generate billions of lots and lots of capital, whether it's Apple or whether it's El Salvador or whether it's Harvard University. They all have capital, but in order to get a yield and protect their principal against inflation, they can't invest in a liquid capital asset. They have to buy real estate. Probably real estate. You buy commercial real estate, and your inflation hedge is the underlying property, and then and then you get some rent, of which a lot of it you have to use to pay taxes and insurance and upkeep and depreciation, and then the remainder, might be some real yield, but it's not much. Generally, it's not a whole lot, and there's a lot of headache with it. And so otherwise, I own a corporation or an equity that pays dividends. So if I can own a corporation that can grow faster than the rate of inflation and grow cash flows faster than the rate of inflation, maybe in theory I can get there. But those are both very, very challenging. So I maybe in the mythical era of, in the golden age, if I had a bank I trusted in the golden age and my capital was in gold, then maybe I could deposit the capital in the bank and I could get paid interest, and the bank would then loan the capital and they would get paid and we would split the interest 50-50 or something. And that's a long-term strategy for, you know, preserving wealth and then paying expenses. But we lost that ability in the fiat age because it seems to me that, with probably only a few exceptions, the actual yield you can generate on fiat capital has always been a negative real yield. I mean, do you know of anywhere in the world where you can generate a positive real yield on fiat capital in a bank?
No, no way. Well, I mean, Lebanon before hyperinflation, you used to get 15% for your checking deposit, for your savings deposits. But look how that worked out.
You have to take some sort of corporate risk, technology risk, or investment risk, or real estate risk. And you have to tell yourself that the risk you're taking is less than the yield you're getting. Right? Like, for example, they loan money to mid-sized companies, all these corporate lenders, they brag about getting 12%, 12 to 14% interest rates on secure loans. And so they're getting more than the 5% the government pays or the US pays. And so maybe they're getting an extra 8%, and they're telling themselves that the risk that they're taking is less than that. But even so you get 12% on that loan, you're getting debased 8%. I don't think the monetary inflation rate right now has been, 7. I think it's been more like 9 or 10 for the past 4 years, right? So in this environment, you were suffering an 8 to 10% monetary debasement rate, and you're getting a 10 to 12 or 12 to 14% yield, and then you've got this risk that you're taking, and you're telling yourself it's not risky, but probably it is 4 to 6% risky. So at the end of the day, if you're taking 4 or 5% credit risk and you're getting paid 12%, and the monetary debasement rate is 8%, then you've got a 0% real yield after adjusting for credit and inflation, right? It's kind of so you're those businesses, they kind of work for the general partner because the general partner is getting paid a fee off the top. But the limited partner that isn't getting paid, that participate, if you're getting 2 and 20, of course you want to do anything. But if you're the limited partner, you're getting a nominal yield of, 8 or 10%, but after the risk, over 20, 30, 40 years, you're gonna have a blow up, which kind of wipes that all out. So we live in a world right now where it's difficult to live off of your accumulated capital without actually being in the business of taking risk. I guess that's what I'm getting at. And I think Bitcoin offers a different possibility. I see a world, we're not there yet, but I think 10 years out, I see a world where you would be able to take your Bitcoin, put it with a trustworthy bank, and the bank would lend it out, and they would give you a yield, and you could then never sell your Bitcoin, pay your living expenses with the yield the bank gave you, and then the Bitcoin would appreciate in fiat terms forever. And of course, for that to work, you have to have a trustworthy bank, right? What is a bank in that regard? I mean, classically, that's a bank that they take capital from depositors and they find creditworthy lenders, and they charge an interest rate that covers the default rate, right? They actually do proper lending. And I guess this is what's interesting here is that Bitcoin is capital owned by the people. And so the bank basically has to get a return for their own shareholders and a return for the capitalists that own the capital, and they have to cover the credit risk. And the existing fiat banking system is using bank owned by the public and by the governments, right? The government controls the capital that existing fiat banks lend out.
This podcast is brought to you by my friends at Coinbits, the oldest Bitcoin-only exchange. If you're listening to this podcast, you get that Bitcoin upends everything that government schools teach about money. Coinbits is the money app designed for people like you who understand Bitcoin and want to use it every day. Coinbits pioneered the concept of roundups, which converts your spare change into Bitcoin. Simply connect your debit and credit cards, and your usual purchases are rounded up to the nearest dollar, letting you save more in Bitcoin as you spend more. My favorite new Coinbits feature is Spending Insights, which gives you real-time feedback about how much of your money is chasing high-time preference, short-term gratification, and how much you are providing for your future with low-time preference choices. As always, Coinbits provides a terrific self-custody experience. Connect a hardware wallet for automatic withdrawals, so you keep counterparty risk to a minimum. Coinbits also offers peer-to-peer cash and Bitcoin payments, target orders, price alerts, and more. Coinbits can help you do almost anything you need with Bitcoin. Go to coinbits.app/Saifedean and get 3 months free. Again, that is coinbits.app/Saifedean, Saifedean. The Bitcoin Standard podcast is brought to you by Orange Pill app, the Bitcoin-only social network that connects you with high-signal Bitcoiners, events, and now merchants as well. If you're like me and can't stop talking about Bitcoin, you know how challenging it can be to talk to the no-coiners and how nice it is to talk to someone who gets you. With the Orange Pill app, you can find the Bitcoiners near you and they can replace the no-coiners in your life. You can organize events and meetups with local Bitcoiners, and wherever you travel, you can meet up with local Bitcoiners, all while being as anonymous as you like. So if you want to build your local network of Bitcoiners, find a Bitcoin meetup or merchants accepting Bitcoin, head over to orangepillapp.com to sign up, or download the app from the App Store or Google Play Store and send me a DM so we can get connected.
And what we really could use is the formation of a set of digital banks that use digital capital. Of course, the first generation of them, we can name them, right? Celsius, FTX, you know, BlockFi, you know, and they were kind of like crypto cowboys, and so they weren't very trustworthy, and they took insane risk, and they blew up. So we don't want that, right? We need a bunch of banks with adult supervision, with credit controls and risk controls that think really hard about this, that manage more carefully. When you find a bank that's got a massive balance sheet, that's got adults running it, that's got good credit controls, that knows how to manage credit risk, then maybe you would consider that bank to be a custodian of your Bitcoin, or you might consider loaning your Bitcoin, depositing your Bitcoin with them. But it seems to me like for Bitcoiners, right, the best situation would be if you ended up with one of these too big to fail banks, like a mega $1 trillion balance sheet bank. If you found a bank with $1 trillion balance sheet that was basically managing a Bitcoin lending business of lending up to 100 billion or 10 billion of Bitcoin, you're just 1%. You kind of want to be a small percentage of a mega balance sheet and have them running that as a side business, and then back all of their Bitcoin loans with, 100x collateral of the overall bank. And this is why you almost don't want the governments necessarily to get out of the fiat business, because the best situation would be the United States government backing one of the 10 biggest banks in the United States that then started to handle Bitcoin and then gave you yield on your Bitcoin and made the loans. And that way you have the credit risk of JP Morgan or Citi or Bank of America. And that allows a Bitcoiner, a Bitcoin maximalist, to own Bitcoin, never sell the Bitcoin, live off of interest from the Bitcoin, and then have the Bitcoin appreciate without diluting themselves. It's a consumer strategy. There are corporate strategies to generate yield off of Bitcoin, but they require that you be a public company like MicroStrategy, and you need to be able to issue equity or debt securities or some other securities backed by your Bitcoin in order to generate a period over period income of sorts.
I'm generally a little skeptical of the idea that we're going to have Bitcoin yields and Bitcoin yielding. I think we're just going to see a lot more Celsiuses and a lot more BlockFis, because ultimately, I don't think this model works without a lender of last resort. I think you need a lender of last resort, and without it, it's not going to work. And I think people are just going to learn the hard way to not do this. I don't see it surviving.
Yeah, well, so my point is, wouldn't you like for JP Morgan to just pay you 5% of your Bitcoin value risk free?
I mean, ideally, I'd like 500%, but I want to keep my Bitcoin more than I want the 500%, chasing after them.
Well, no one's gonna pay 500% interest on a loan.
Yeah, and I think the 5% as well. I mean, if everybody's got their Bitcoin in 5%, well, how are you going to make more Bitcoin? Eventually, you're going to have more Bitcoin needs to be paid than there is Bitcoin in existence.
I'm not talking about issuing more Bitcoin. I'm saying that the current risk-free, rate, if you have money at JP Morgan, you put it in a money market, it pays 550 basis points. So wouldn't you like to get 550 basis points on your Bitcoin balance without converting it to dollars, right? Right now, you have to convert it to US Treasuries to get 550 basis points. But if you do it, it's effectively risk-free. I mean, it's
Ooh,
pretty close to risk-free.
it's not, man. I don't think it's risk free. I think it works with
Unless
fiat.
the US government fails, I mean, the US government's not gonna let JP Morgan fail.
Yeah, but the US government has already failed several times over the last century. In 1934, they defaulted on gold. In 1971, they defaulted again on gold.
Okay, well, fine. So now you're going all maxi on me, but if that's the point, let me just make the point that there's no way that El Salvador is going to pay their expenses without selling their Bitcoin if no one's willing to give them yield on the Bitcoin, right? In your world, if you have expenses, you're going to have to sell the asset
But
and
you're gonna have incomes. So you cover your expenses from your income and you keep stacking sats and you grow up your stack
well,
forever.
the point is if the capital doesn't generate a return, it's a non-performing asset. So you need to you need to address the issue. If I put $100 billion into Bitcoin and I get 0% yield, that's just as bad as I have 100 billion in US bonds that pay 0% yield. In both cases, they're non-performing assets. I'm going to have to sell my house, my kids, my whatever to pay my hospital bills if I don't get any yield off of my assets. It's non-performing. So I think if I had 100 billion in buildings and the rent was zero and I had expenses for the building, it's a non-performing asset as well. So at the end of the day, you have to answer the question, how is Bitcoin going to perform as an asset? You're going to have to actually have a functioning banking system that will actually loan out the capital. If the capitalism requires capital, requires banks, requires lenders and borrowers, right? I mean, the basics of Austrian economics is some dude has more money than he needs, and somebody else needs the money in order to build a factory, and that's why you have a banking system and you have lending. So my point is lending's not bad, banks aren't bad, lending Bitcoin isn't bad. Ultimately, if you imagine a world where there's hundreds of trillions of dollars in Bitcoin, we need a functioning banking system to move the capital around, right? And if the capital does move around, then you. Why would you apologize for getting paid a return on your capital?
I'm not saying you should apologize. No, no,
I
I'm
mean,
not
but my
saying
point is, it's not a dirty word to get paid return on your capital. If you have 100 billion in capital, why wouldn't you get paid 5% on it? I mean,
because you're gonna have to risk it. You're gonna have to risk it in order to make that return. So I think what would
okay.
happen is that you banks would exist, but what they would do is that they would allocate equity. So you take the $100 billion, you put them in a business, and then if the business makes money, you make a return. If the business loses
I
money, you
understand. So
lose
my
return.
point is, if you're a guy with $1 billion of gold in the year 1800 and you put the gold under your mattress, you don't get any yield on it and you don't lose your gold. You take no counterparty risk. And if you take the gold and you give it to a bank and the bank loans it out to somebody else, you take some risk to the bank. The bank takes some risk to somebody else. The traditional economist would say the healthier economy is the one that has a functioning credit system. And if I'm in a city and a 22-year-old can't get a loan to start a business, the economy is gonna grow slower. So there's nothing wrong with a functioning banking system and a functioning credit system if it's rational and it's well run. And I don't think there's anything wrong, like a guy wants to make an investment and take risk. I mean, risk is part of capitalism, right? And so you don't have to take risk.
Yeah, but I look, I mean, I'm not saying there's anything wrong with it, and I'm not saying you shouldn't do it. I'm just saying that in a world in which the money supply is fixed and there's no lender of last resort, in a world in which JP Morgan doesn't have a magic money printer, because JP Morgan prints money. It's not just the US government and the Federal Reserve that print money. JP Morgan is also able to print money, and they can borrow from the Federal Reserve at the lowest interest rate.
Right?
So in that kind of fiat privilege system, they are able to offer you 5% because they are printing that money. They're going to be able to pay you. They make the $1 billion that they lend you in the first place out of thin air, and then they get money from the interest that they make on other people's billions of dollars that they made out of thin air. That that game stops in Bitcoin. There's no lender of last resort. So now, if you're a 22-year-old and you have a business idea, you need to find somebody
Right.
to get you equity. And I don't see that as a problem. Why is that a problem? You get equity, you share in the upside, you share in the downside.
10 years from now, we're still going to have the dollar, Saifedean. We're still going to have banks. We're still going to have governments, right? You're imagining a world where the governments and the banks go away. It's not going away, right? And so, in a world where there is a lender of last resort called the United States, and there is a big bank, and there are people with currencies, and Bitcoin's in that world, then it's quite possible that the bank will give you a loan or the bank against your Bitcoin, or the bank will give you yield on the Bitcoin. And this, you know, if you go back, what I'm saying is your ideology seems to be like there's something bad about banks or something bad about lending or something bad about getting interest. There's nothing wrong with lending, borrowing, or paying interest. And if we just got rid of fiat and we replaced it with gold on a gold standard, there's a place for a bank to take your gold deposit and then to loan the gold and to charge a fee, interest for the person that borrows it, crank in a credit spread, and turn around and pay you the risk free rate and keep the credit spread, or pay you half the risk free rate and keep the credit spread. And that's just banking, right? And it's not, you can choose as a capitalist to loan your gold to a bank or not. But just like I have a building, right? You're a real estate guy. If you don't want to take any counterparty risk, you can buy 1,000,000 acres of land and not rent it out. There's no counterparty risk, right? Nothing's going to destroy the land. Or you can build a building in Manhattan with 100 stories and you can rent it to a corporation. Now you have counterparty risk, right? They're both real estate strategies. And if you build a 100-story building and you don't rent it to a corporation, it's a non performing commercial real estate asset. So that makes no sense. With Bitcoin, you have either choice. You can actually be hyper conservative. You can just bury it under your mattress and you'll get the Bitcoin return. Or you could lend it out to someone and you could get the Bitcoin return plus the yield they pay you, and you absorb the counterparty risk of them not giving it back to you. And the latter is more risky. If you basically lend your Bitcoin peer to peer, that's extremely risky. That's why banks form in the middle. And you're saying, well, what if there's no lender of last resort? Well, as long as there's a government, if the government creates a national bank, and if the national bank decides to get into the business of you know holding gold and holding Bitcoin and holding whatever, like Apple stock, right? So I put my Apple stock with the Bank of Switzerland. I put my gold with the Bank of Switzerland. I put my dollars and my Bitcoin with the Bank of Switzerland. If the Bank of Switzerland will give me interest on any of those things, would I take it? Yeah. If I trusted Switzerland to back the bank, maybe I take it. Will you? Well, I mean, that's just a function of risk tolerance. Do you trust the Bank of Switzerland or not, right? And I don't trust Celsius. I didn't put my money in FTX, and so I get the fact that a fly by night operation run by a bunch of people that don't understand credit shouldn't be trusted. But I do have, and my company has a lot of money in places like Citi or Bank of America or J.P. Morgan, right? And they're backed by the US government. And the truth is the entire, every big tech company and arguably, Microsoft, Amazon, Meta, all of them are doing business with those banks. And if you take away the banks, the economy shuts down. So I think there's going to be banks. If you I do have to ask the question though, right? I put the question to you. What's the point of El Salvador or your family accumulating all of your capital in Bitcoin if you expect 0 yield forever and you're never gonna borrow against it?
You stack enough so that you can cover your expenses, and then you keep earning. You also
Well
accumulate assets that have earnings.
well, the point is if you don't borrow against it and you generate no yield on it, then you're just holding it as a reserve, which you expect to sell at some point in the future in order to pay an unforeseen
That's
expense,
what money
right?
is. That's the
It's an
definition of money.
insurance policy.
That's what money is. That's the definition of money. I mean, it's only because of uncertainty that we hold money. If it wasn't for uncertainty, we'd hold performing assets. But money is better because
But you're imagining an economy that has no banking and credit.
no, I think it would have banking, but it would have equity.
Banking and credit are good for the economy, and I think that you're too extreme to take the position that there should be no credit in the economy. I think
There's
that
no should. I'm not saying should. You're a grown adult. You do whatever you want. I'm not out there to tell anybody what they should do. I'm just saying, in a world in which you only have 21 million and you don't have a lender of last resort, I don't see how this model survives. In fact, I think another way of looking at it,
what model?
the
What
model of
model?
being able to give yield on money. So you mentioned the example of gold 200 years ago that you could have put it on the mattress. Yeah, if you
Wait a minute, even before fiat, there was we've had gold standards off and on for 10,000 or thousands of years, and if you read through thousands of years of history, there's been a persistent interest rate against gold, 4,
absolutely,
5, 6%.
absolutely,
And so there is interest in a
yes.
sound money economy,
So
right?
this
So
is
you're saying, I don't know how it survives. I mean, the point is, we've always had interest. In fact, the oddity is that we don't have lending and interest on sound money in the last 30, 40, 50 years because the norm has been that you would expect to get interest on sound money in the same way that you expect to get interest or a return on sound real estate assets. If I loan you my building for 10 years, I expect you to pay me and a certain amount of money over a triple net, like over and above the cost to maintain the building. At the end of the 10 years, I still have the property and I've also got a yield. And so the idea that I get interest on a sound money asset, I don't think is unreasonable in the future because it wasn't unreasonable in the past.
well, so there's a great book by Homer and Scylla. It's called "The History of Interest Rates" or a 5,000 year history of interest rates. It's a fascinating book, and it collects data, numerical data on interest rates throughout human history, from Babylon all the way down to today. And they make a very, very interesting observation, which concords with what Austrian economists would say, which is that historically interest rates have been declining. And that's what an Austrian would predict because that's what the process of civilization is. So, from the Austrian perspective, interest rates are a function of time preference. As time preference declines, people are able to forego present consumption in order to save for the future. And so they have more and more resources. The more resources they have, the lower the cost they're willing to accept on those resources. So, the bigger the stack of money that you have, the more savings you have, the lower the interest rate that you would take. And the more savings that other people have, the lower the interest rate that you have to take. So historically, what we see is this 5,000 year process of interest rates declining and declining and declining and declining on the gold standard. But of course, there are always these interruptions. So a war happens, and we used to be at 6%, and then a war happens, and we shoot up to 60%, and then governments fail or bad things happen, and then interest rates come crashing back down. But the fascinating thing is try and imagine a hypothetical scenario where in 1914 we stayed on the gold standard. So by 1914 the lowest interest rate in the world was the lowest interest rate in history, which was 2.5% for the Bank of England. That was the lowest interest rate. Now imagine they stayed on the gold standard. Now, of course, when they went on fiat, it all shot up. It kept going up until the 1970s.
But indulge me for 2,000 years. Like, what's the reasonable range of interest on sound money?
Depends on people's time preference.
Somewhere between 3 and but just the numbers that are like, I could also quote 100 examples out of history of civilization where they say 4%, 5%, 6 normally, they have for trustworthy counterparties, single digit interest rates, right? And so these guys must have some range of interest rates on sound money that have historical preference. What is it roughly?
Well, I mean, it changes over time, so it's basically a constantly declining rate of interest that continues to decline.
Well, it's not constantly. You just pointed out, like, and
Well, not constantly, in the long term.
it varies, right? And in times of war, it would shoot up. In times of peace and security, it might come down. And of course, there's a lot of what is the word? There are a lot of variables. But all I'm getting at is, can't you find that it's not abnormal to have 4% interest rate on sound money? I mean, you can find plenty of examples of that throughout history, right? 4, 5, 6.
Yeah, it continues to decline. So this is the chart. I'm gonna show it to you here. I'm gonna share it right now. So as you see here, this is gone. I just dug this up from Google. So this is
I
from
can't I can't
3,000.
see the numbers, it's too small, but, like,
Uh,
look, the real issue is there a natural interest rate or historic interest rate on sound money? I think there is.
yes, well, from the Austrian perspective, it constantly declines over time.
And I think Bitcoin is sound money. So
Not
if
constantly, but the general trend is for it to decline, and then bad things happen, like the 20th century here, as
well,
you see.
decline from what to what? Like what?
Well, so 3,000 years ago, it was 20%, 10%, 18%, and over the last couple of thousand years, it's gone down. As you see here, by 1900, around the time of going off
I don't I don't buy into your thesis, which is you're painting a world which is very simple, like, oh yeah, interest rates just go down over time because of civilization. Well, that's the real question is, what's the value of the capital, right? And why should they go down or go up? And can you actually measure it against sound money? So
So that's not the Austrian theory on interest rate. It's not about the productivity of capital. It's about the time preference that makes the capital available. This is how Austrians they call it the pure time preference theory of interest rate.
look, here's the real point, Saifedean, which is you're taking the position that capital has no value. I disagree.
No, I'm
I
not
think
saying
I
capital
think
has
the
no
I
value.
think capital has value, and I think Bitcoin is digital capital. And so to imagine a world in the future where Bitcoin doesn't have value doesn't make any sense to me. If you have capital, then I think you'll be able to loan it to someone or rent it to someone, and they're going to pay you for it in the way that people did make capital available in the past. And the history of humanity is full of examples of banks that made loans of sound money and got paid, and people that paid interest on it. And you're basically taking this position that somehow interest rates go to zero forever because of something, and I don't get the something. If Bitcoin is digital gold in the future, then you should be able to loan it to someone and get paid interest on it in the same way that we loaned gold in the past to people and got paid interest on it. And we can debate over what the number should be, but the debate is, certainly I'm not going to give you the Bitcoin for free. I'm going to expect to get paid for it. And if someone's going to pay for the capital, then there is a business model there. And it's worthwhile to consider the implications of that when Bitcoin is worth $100 trillion.
No, I agree. I'll just let me give you my theory on this, which is kind of, I mean, so the Austrians, one of the major contributions of Austrians is to make the case for interest rate. So I'm a bit of a heretic within the Austrians by having this idea, but from
Apparently,
yeah,
if you're against interest on Bitcoin, you're against interest on sound money.
again, it's not against. It's not me saying should. It's just me taking the point to its logical conclusion, which is from the Austrian perspective, it's about time preference. So the more savings you have, the more your time preference declines. And the lower the cost that you're willing to accept for your capital. So now extrapolate this again another 10, 20, 50, 100, 200 years. Eventually, we get to the point where everybody's holding cash balances that continuously appreciate. So capital is enormously abundant and interest rates have to continue to decline.
Okay, well,
Hang
this
on,
is
hang
okay.
on,
We'll just
hang on.
stop right there. That's not true. Everyone is not.
Well, okay, not necessarily everyone,
Right? Everyone is not holding Bitcoin.
but people who want to lend have an enormous amount of capital.
The point
And
the point of the point of the economy is there's always somebody that has money and someone that doesn't. Saying
yes,
everybody has the same amount and they all have enough,
no, I'm not saying everybody has.
negates interest, but that's ridiculous. People don't have money, right? There's a lot of people that don't have money.
No, I'm saying capital continues to accumulate. A lot of capital continues to accumulate, so time preference continues to drop, and then the cost of capital drops below the cost of storage of capital. That's the key thing. So the nominal interest rate drops to zero because storing money becomes more expensive than the market interest rate. So I'd be, if I trust you and you're an 18-year-old and I know you and I know that you're worth taking a punt on.
I'm not following you at all. This makes no sense to me. Like, if you have $1 billion and someone else doesn't have $1 billion, you're not gonna give them the $1 billion for 0, and they're not and on the other hand,
Because holding the $1 billion costs you a sum because you can't make a
it
yield on
costs
it.
you nothing. I mean, the custody cost of Bitcoin is 10 basis points or less.
Not exactly. I mean, you still gotta secure the place where you're putting it. You have to make sure that your house is secure.
You're not addressing the obvious thing, which is there's a 65-year-old that's retired that has plenty of capital and they wanna live off their capital. And there's a 22-year-old that's starting their career and they wanna borrow the capital.
Mhm.
And in normal
Equity.
healthy society, it's totally
Why not do it through equity? All I'm saying is that
you're just
lend
an ideologue now. You're
it's not an ideologue. I'm just showing you the economic perspective from the idea of the time preference theory.
you have lurched into arguing against banking and credit theory, which has nothing to do with Bitcoin even. And like you're basically arguing against anybody being able to borrow money, which is ridiculous. If a 22-year-old wants to borrow money to buy a car so that they can drive it from point A to point B, your position is what? You have to take yourself public and sell equity in the car company because I don't want to give you a loan?
No,
I
consumer
mean, like,
goods could.
I think you're getting very idealistic here. If a 65-year-old, they want to retire and get paid 5% guaranteed on sound money and live happily ever after with no stress. They want to give it to a bank, and the bank is going to want to loan it to the 22-year-old who wants to set up a business. And the 22-year-old doesn't want to give equity. Like when I started my company when I was 24, I didn't want to give any equity to the people that gave me the capital. I wanted to borrow the money, pay the interest. And so the the world for thousands of years has operated with one group of people making loans and one group of people wanting to borrow money. And there's always going to be the young, the orphans, the entrepreneurs that don't have capital, but they have time on their hands and energy and ideas. And there's always going to be people who are retired who have plenty of capital and they don't want to take the risk. They don't want to be equity investors. And so you're talking about time preference. It's a lot easier to have long time preference if I can retire, take no risk, and live off of my savings forever.
But there is no such thing as no risk. There's no such thing as no risk. There's always risk involved. And I think what fiat did is that it allowed people to basically outsource the risk to inflation. The central bank comes and bails everybody out when your loan goes bad.
Yeah, you're changing the subject here to like something totally different. We're talking about
No, because ultimately it goes down to the fact that Bitcoin supply is fixed. Because Bitcoin supply is fixed, there's no lender of last resort, and so lending is always inherently risky. But also, savings accumulate, so the size of people's cash balances go up. And so, what happens when something becomes much more abundant? If cash balances are 100x larger than what they are today,
okay, let's come again. Just answer me this question. How does the person with no money start a business, buy a house, or do anything while another person with all the money sits there? How does the person with all the money actually how do they actually live if they can't get any yield or get a loan on their asset?
they spend some of their money. It's not rocket science.
They have to sell their money.
Yeah, that's what money's for.
Oh, how does the person with no money buy it? How they
They
you're
work.
you're imagining an economy without credit.
I'm imagining an economy in which credit is either provided at an interest rate that is nominally zero because it is better than holding the cash because cash is so abundant and, and holding cash has a cost, or credit is provided in the form of equity, in which in the case of business. So the 22-year-old who wants to open a business might be able to find a cousin or an uncle or a friend who can lend him money for no interest rate, or because it's cheaper to give him the money than to keep holding on to it, or you'll find somebody to get equity in
Why
the
would
company.
okay, well, you just
And
sound
again, I'm not saying
I
it should, and I'm not saying you should ban it. So the key thing is I'm not saying
I don't know, now you sound like somewhere between a communist and a socialist. You're like, you wanna pass a law preventing people from borrowing money.
no, absolutely not. This is economics. This is just if the time preference continues to decline, then the interest rate keeps declining.
Well, why you wanna pass a law to keep a bank from making a loan?
No, 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 no. The
Like,
point is that this becomes as a
what's
market.
wrong with a loan? What's wrong with a lot? Like, what's wrong with issuing a credit card, or what's wrong with a business loan or a mortgage, right?
So
You
again, the
have
key
some kind
thing.
of ideological hatred for credit or a loan, but it's nothing to do with Bitcoin. It's nothing to do with Austrian economics. It's nothing to do with sound money. It's just you're just taking this position that someone shouldn't be able to take a loan or make a loan for some random reason.
Again, I'm not saying that somebody should or shouldn't. Nowhere in my analysis did I say the word should. I think what's happening here is I'm just extrapolating the economic trends. We've got a couple of trends that you extrapolate, and then if you keep extrapolating them long enough, eventually you get to the point where cash balances accumulate. What happens if you have a lot more apples? If you have a lot,
That's ridiculous. Like none of those you can't can't extrapolate any of these trends.
why not? Cash balances continue to accumulate, so people have a lot more cash. What happens if we have more apples? The price of apple goes down. So if capital accumulates, then the price of apple goes down.
You might as well take the position that nobody can rent a house.
No, I'm
You
not.
might as well take the position that you can't rent a house or an apartment as long as you're going down that train of thought.
I'm not saying that that is the case. I'm saying, look, I'm just saying that capital is a different good because it continues to accumulate and it's something that is acquired differently from a house. There is no use of money in the same way that you use a house. But anyways,
Okay, that's totally wrong too. If I have $1 million in Bitcoin or $1 million in a house, they're both capital assets. I see a world where you can sell your house or you can rent the house. And you're contemplating a world where you're not allowed, where it's illegal to rent the house and no one will ever rent the
no,
house.
no,
And I'm
no,
saying
no. At no
it's
point did I say it's
ridiculous to take
illegal.
the position that you can't rent the asset.
I'm not saying you can't rent it. You can do it if you want to. I'm just saying that on a market in which money continues to appreciate and time preference continues to decline, eventually you see a lot more equity. That's all that I'm saying. And I'm not saying it should. I'm not saying somebody should legalize it or criminalize it. I'm just saying this is how it would naturally go. But anyways, we've spent enough time on this. Now let's. I want to go back to your credit and still in a fiat world. Obviously this has worked out very well for you, but do you still recommend this for people, and what are your criteria for? I've asked you this question like 3 4 years ago when thinking about getting into bitcoin on leverage. Now when I asked you that question I think it was November 2021, so it was very much near the top, and so since then we've had a massive decline of I think 80% or so. So what is the criteria that you think people should take care to do if they are thinking of borrowing against their Bitcoin? What is the interest rate that you think? So you can get you've gotten credit at like 3 5%, but most people can't get these
I
prices.
don't think, I don't see there is any easy way to borrow against Bitcoin right now.
No, not borrow against Bitcoin, borrow fiat in order to buy Bitcoin, which is what you're doing.
I think that you should only buy Bitcoin if you're going to hold it for 4 years. And so a reasonable thing would be to make sure that any loan you had has to have a minimum 4 year duration. You want to, yeah, and you want it to be not a mark. You don't want to borrow money on a mark to market basis with against your existing Bitcoin. You never want to do that. Um, but the ideal example would be take a 10 to 30 year real estate loan. So you're marked against an uncorrelated asset. I mean, a real estate loan is like a lot of benefits. First of all, a mortgage is normally subsidized by the government, so it's below market rate. And number two, it's an uncorrelated asset. Number three, it's a long duration loan. 7 years would be short, 10, 15, 20, 30 would be better. And then number four, a lot of times the cultural norms and the banking norms with real estate loans or home loans are you're not allowed to write them down. Like, like there's banks normally don't want to mark down the asset value of a piece of real estate. if you're borrowing against something that's marked to market every day, you're borrowing against your GameStop stock or something where it could drop by 95%, right? The banks will definitely write down that asset and then call the loan. But they very rarely write down a home in a suburb. So a stable long duration loan is the best. You obviously want the lowest possible interest rate. And I think generally you want to buy Bitcoin for more than 4 years. I mean, the right time horizon is you buy it forever, and then otherwise more than 10. And if you can't, and the bare minimum is 4. And if you don't have the capital to hold it 4 years, right? And there's two ways to do that. You can, if you were all liquid, you could say the portion of my portfolio that I don't need to spend for 4 years. And if you're going to borrow money, then it needs to be a loan that won't come due for less than 4 years, right? But ideally, you would like to double that, right? You want the longest duration you can. I definitely wouldn't buy Bitcoin on credit card loan. If you got 20% interest rate and it could be called or come due in 12 months or 18 months, that's a bad idea. I wouldn't do that. And of course all the traders, they trade 10x, 20x leverage on Binance and crypto exchanges. That's silly because what happens there is on Saturday night, there's some kind of fake news or something, a scare. The market liquidates, it crashes, and you'll get forced liquidated while you're sleeping and lose all your capital. So that's really just gambling. So that's what I think about that. Long duration, stable, debt. One could reasonably assume that if the cost of capital for you is less than 8%, and if your duration is 8 years or longer, you're probably pretty safe. And if when I discussed this, like I discussed it about 2 years ago, the 30-year mortgage rate was 2 7/8. It's like 2.8% interest. Well, Bitcoin was like in the mid 40s or 45 or whatever, but that doesn't really matter that much. What matters is you can take a long duration mortgage for low interest rate. And where this and actually the context under which I discussed this, where it's most famous, was I was literally talking about the right strategy for a company in Argentina. And that's when the Argentine peso was trading at 180 pesos to the dollar before it devalued by 5 to 1 from there. And so in a weak currency environment, you just want to trade the weak currency for the dollar. But the best thing going if you want to get rich is to borrow money in a collapsing currency. If you borrowed money in pesos and traded it to dollars, you would get rich. But if you borrow, I mean, people try that all the time. They always try that carry trade or currency trade where they try to find a weak currency against a strong one. But the best thing possible would be you borrow money in a super weak currency on a long duration, and then you buy Bitcoin with it. But it's always the duration risk that catches you, I think, or redemption risk. And if you look at what MicroStrategy does, like when we do a 5 or a 7 year convertible bond, we're borrowing money for 7 years at 1% interest, but no redemption rights, no covenants, no recourse. And so we're not really pledging any collateral. So that's an example where
No Saturday night liquidation.
you can, if you can live through a 90% drawdown and not get forced liquidated, then you're going to be fine, I think.
You think 90% is the cutoff?
No, I don't think it'll be that bad
Let's not
anymore.
tempt fate. Last time here, a couple times ago, you said 70, 80%.
I remember you said it might go to 75 and I thought it wouldn't, and you turned out to be right and I was wrong. But it didn't matter. I had structured my balance sheet so I could handle a lot more than 75%. And it turned out to be, ironically, a good thing in a way, because it created opportunity as much as it created stress. But I do think that as the asset class grows and as you have more participants, the volatility decreases, and that's just a natural dynamic. The options markets decrease volatility as they grow. The spot ETFs decrease volatility. The more capital decreases volatility. and the size decreases volatility, and so there's a lot of things that decrease volatility over time. And so I think, it used to be Bitcoin was right now it's like 50, 55 vol. It used to be more volatile than that. I think that, it will have a journey going from more than 100 vol through the 50 vol to 40 vol to 38 to 35 to 32 to 30. And I think that, the VIX, if I pull my screen up right now, the VIX is like, 17, and DVol, which is VIX is the S&P vol, so it's 17, and DVol is Bitcoin, which is 54. So right now we're marching toward the VIX, but I don't think we will ever get there. I think we'll get to VIX plus 8 or something like that, or VIX plus something, because Bitcoin will be more volatile because it's global, open 24/7, 365, more highly levered, et cetera, more useful.
So you think if you came in 8 months later, so you came in August 2020, February, and let's say you took the orange pill 8 months later, you came in at February 10th, the price was 58K, roughly where it is right now. Do you think your strategy would have survived? You would have been okay, right? You could have handled a 90-80% and still not gotten liquidated, right?
Yeah, we weren't gonna. I think that the only thing that we had in our balance sheet that was a moving part, that was a pain, was this $200 million Silvergate loan. When we took that loan, we took it 20x or 25x over collateralized. So it was like a loan to value of 2%, or, so 2 or 3% or something. Like, I think it was, I think probably we had collateral. Yeah, we definitely had more than, we had like $10 billion versus a $200 million loan. And then the market crashed 75%. And so we were still way over collateralized. But what we decided is just not to ever use the Bitcoin as the collateral in that circumstance. Just didn't make sense.
Yeah, I guess that does make sense. Well, Michael, thank you so much for your time. Thank you so much for all the insight and all the conversation. Always fun talking to you, whether we agree or disagree. And we do agree a lot more than we disagree. Let's remember that and end on that note.
Yeah, thanks for having me. It's been interesting.
Cheers, man. Any final words?
Final words. I mean, I think 2024 is going to be a good seasoning year for Bitcoin. I think we lived through the crazy years, and I think that this is this is the year one of institutional adoption. Most of 99% of the money in the world hasn't been able to buy Bitcoin, hasn't considered buying it until the spot Bitcoin ETFs hit in January. So here we are, we're like 6 months after that. We're not even 1 year into year one, into the age of institutional adoption. And there's just a lot of stuff that's going to happen from this point. And, there's, each one of those milestones is hardening and stabilizing the asset class. So I think the challenge for people is everybody wants to look at something that's happened in the past and extrapolate forward, but I think we have to really look to first principles, because there's just a lot of, this is a market that is where the structure is changing. Like every 3 months, the fundamental structure of the market is changing, and therefore, if you want to extrapolate from history, you need the structure to remain the same, over a longer period of time. Otherwise, it's like extrapolating 10 years of bicycle riding, and a new guy's got a motorcycle and enters the race. And it's like, well, the motorcycle is structurally different than the bicycle, so all the bicycle data isn't very relevant anymore. And I feel like with the Bitcoin market, there was a structure in the market between whatever 2016 and 2020, and there was a different structure that evolved. And, Lord knows, with the crypto crash and the meltdown of FTX and all these other companies, the structure really changed a lot in that time period. We're moving into a third structure, and when big banks get approved to custody Bitcoin, there'll be a fourth structure. I mean, another structure. And I think you have to watch the structures very carefully. And then, then after we've lived with a certain structure for a period of time, then we'll start to be able to extrapolate based upon other, more basic mathematical principles. But right now, all the structural changes I see are good ones. They're very bullish ones. And whereas there's a lot of uncertainty in the future, a lot of uncertainty about what happens, there is one certainty, which is Bitcoin's good. I mean, Bitcoin's winning, right? So that's why that's why I try to avoid forecasting either a win or a loss of these other things because they're so complicated. But the safe strategy is get yourself positioned where you can hold your Bitcoin for at least 4 years. And then all these other, whether these credit markets form or whether they don't form, and whether you can borrow from a safe counterparty or not, all that stuff, I don't know whether you can or can't for the next 4 years. So what you really want is you want to be as long as much Bitcoin as you can that you can hold for the next 4 years, and then let all these positive developments take place. And then I think, I think there'll be great opportunities and great things to talk about. But for now, enjoy the ride.
Absolutely. And we'll definitely have you on again to talk about more fun things and to enjoy the ride. Thanks again.
Okay. All the best, Safe.
Thank you. Take care, Michael. Bye bye.